What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Investor Research Survey. Joining the podcast this week is my colleague Stephen Gregory, who heads up the quantitative research team at Piper Sandler, and Alex Goldfarb, Managing Director and Senior Research Analyst covering the real estate sector. We'll be talking through the key themes shaping markets and real estate right now and what investors should be watching in the months ahead. Alex, welcome to the podcast. Can you give us a quick rundown of your space? Real estate is a pretty broad group and probably become even broader over the years with all the data center build-outs. So give us a little rundown of the space you cover, if there's any kind of specific industry that you're focused on, and then we'll talk about the lay of the land. Obviously, this has been a sector that's been in the crosshairs of risk for many years with interest rates going up, but also doing well from the data center build-out. So quite a diverse story.
Sure thing. So you're right. Real estate is pretty broad. It's interesting. When I joined way back when, real estate was sort of this esoteric asset class, sat in its own in the corner. None of the other cool kids talked to REITs. And then, we had the dot-com bust, and suddenly people discovered yield-bearing instruments, and then off to the races. So real estate is definitely mainstream, but unfortunately, from an investor standpoint, they still view REITs as this weird sector. And it's really interesting when we speak to investors, like AI, everyone's talking AI and crypto these days. People have no problems buying either of those sectors, right? Whatever the companies are, they buy them. You ask them anything about how those work, what the mechanics are, what the investment spend on the back end, they have no clue. But hey, it's crypto, it's AI, we'll buy it. Then you go, well, hey, what about an apartment REIT? I don't do REITs. I don't understand them. Have you ever lived in an apartment? Have you paid rent? Have you gone to an office building? Have shopped at a mall? And it was funny because pre-pandemic, everyone hated malls. Everyone hated retail. Internet was going to take over the world. And then you'd ask them and go, what would you think would happen to the U.S. economy if everyone stopped shopping at the mall? And they're like, yeah, it would create. I'm like, why? Because the day the country stops shopping at Short Hills or Roosevelt Field, this country is broke, closed for business, right?
Yeah.
And so the interesting part of real estate is it's actually a very simple business. I like movies. If you remember the movie Jaws, sharks are really, they're simple creatures. They eat, they swim, and they make baby sharks.
Yes.
All REITs do is collect rents and pay dividends. That's all they do. And they do that because they are a derivative of credit in the economy. So if you have a view of where interest rates are going, if you have a view of the economy, then investing in REITs should be a no-brainer and simple construct. So it's interesting sitting here and today, we've been bullish for the past few years because literally there's no new supply. We had an apartment wave that's ending this year, but when you look past, industrial development has come down a lot. Office development has basically come to a stop. Retail development came to a stop back at the GFC. So all these sectors we'll leave data centers aside, have had very little supply. At the same time, what COVID did and the interest rate environment did is it made people focus, one, on well-located, well-amenitized properties. It also made people think more about how they want to live. And it also made people realize that for office, what people want is convenience and proximity. And so when you boil it down, you end up with an environment where occupancies are near full for the most part. Even office is like most of the office REITs are going to be, sort of mid to upper 80s. 2 years now, we've done this bull bear debate on housing, and it's been awesome. Great debate. But it's interesting because one of the points we make is that for all of the talk about this excess apartment supply, and for all the talk about housing and interest rates and mortgage rates, what we know is despite having 2x the amount of apartment supply last year and this year, rents are only down minimally overall. And that's really in a few markets like the Phoenixes, Austins, Nashville's of the world. So the fact that you have this much inventory of new apartments and yet rents are barely impacted And on the flip side, like we cover Howard Hughes, the master plan community builder. They continue to have record land sales to the home builders. And it's not like all of those are like primo baller type multi-million dollar jet set pads in Vegas. It's everything from homes that would sell for 400,000 on up to really the condos in Hawaii are in that $4 million, $5 million range. So the point is, it's a wide swath, but it's really in the middle of what the bulk of the housing is. And the home builders keep coming back to them and buying record amounts of land in dollar values. So my point is, looking today, you have a rate environment that's coming down. You have an economy that is trucking along. The consumer has now had to stomach 4 years of 25% aggregate inflation, which I think people continue to underappreciate. And yet you look at real estate and you're seeing this boom where Midtown office, a sector that everyone left for dead. No one was going to go back to work, much like no one was going to shop the mall ever again. And yet what is one of the hottest institutional capital investment areas? Midtown office. So I think when you look at it, the group should do a lot better. Unfortunately, if you're a REIT investor, you're pulling your hair out because the group has lagged, because I think to a large degree, crypto, AI, other areas that are more exciting garner the incremental investment dollar. Two, REIT earnings right now are going to grow 4% or 5% is considered, wow, that's breakneck speed. That may not be as exciting. And then finally, just the rate environment. People say, hey, you know what? Even though rates are going to come down, it's still a high rate environment. REITs are still rolling off ultra low rate debt that's still going to be a headwind over the next few years. So, those parts have been tough. But when you look at the actual fundamentals, when you look at the drivers, real estate has never been in this strong a position in the past, probably since the end of the Second World War.
That's quite a contrast. We think about the last couple of years, somebody who superficially followed financial markets and macro, everyone heard about commercial real estate, and many people were old enough to remember the GFC. Some of us are old enough to remember GFC and Y2K 2000. So, of course, that's still in somewhat recent memory, GFC that is. I think quickly people were quick to jump on a similar analog with commercial real estate from what happened during the housing collapse and financial crisis. Clearly that hasn't happened. I still hear people talking about that. And I understand the office space nationwide has a good deal of bifurcation in it. And for the last couple of years, there's been the prime quality spaces have held up much better. And then the derivative of that fear was about, well, all these regional banks are going to blow up. Why hasn't that happened? What did people get wrong?
If you forgive me the analogy, it's sort of like having a view of football based on every one of the New York Jets, right? That's what it is.
Ouch.
People assume the worst case when they hear commercial real estate. So if you think about sports, think about the Bills, the Chiefs, the teams that seem to win or get further into the postseason versus, as I say, Jets, Giants, now the Patriots. So commercial real estate, people love to lambast, but it really breaks out into stratification. And when you look at what the REITs tend to invest in, it truly is the higher quality assets, the better capitalized. And certainly the market is pretty punitive. So when you do get REITs who do dumb deals or highly levered balance sheets or have proven to be inept, those REITs tend to trade very depressed multiples, right?
Yep.
So, that's one. Two is people forget. There's a wonderful old adage. Earlier, we were talking about buying a new car. I don't know if you're getting a car loan or not, but let's suppose you're getting a car loan. You go into the dealership, you get a car loan. You don't pay your car loan, repo guys are going to pull it off your driveway the next day, right?
Yeah.
Now, you're commercial real estate, you have $1 billion CMBS on an office building, and you decide, hey, I'm not going to pay. Suddenly, those CMBS guys don't really want to repo that office building because they don't want to touch it. And what I think the past few years have really shown is real estate has value, and the more that you borrow, the more you control your destiny, not the other way around. And there's a workout, right? Mutual assured destruction. So yes, a bank can play hardball with a very small borrower,
Yep.
but once they're on the hook for a very large amount of money, it becomes more difficult. And no one wants to raise their hand and tell the regulators, hey, I have a non-performing loan. I'm going to take a reserve against it. And the regulators, to their credit, which, kills me to say that, but to their credit, the regulators have realized that just foreclosing on properties is not the best use. So think about it this way. And the analogy we use is when a freighter runs aground, the owners don't immediately call the wreckers to start ripping the ship apart. They wait for the tide to come in and out. And over time, through the tide, through tugs, can we get this freighter afloat and get it off the sandbar? And that's what people have realized, and the regulators realize is rather than telling all the banks, hey, you have to, if the guy can't refinance, foreclose, auction it, and go scorched earth. No, give them some time. Maybe it's a little bit of forgiveness. Hey, we'll forgive a little principal, you kick in a little, we'll adjust the interest rate. There's no constitutional amendment that says an interest rate has to be reset to market, right? So the banks and the regulators have worked with the distressed owners to say, what is a way that we can work this out in a way that refloats the ship? Now, you have a building that's completely, can I say verkauft or stupt if you want to use a Yiddish word? Then yes, that property is getting foreclosed because there's no equity, right? There's no recovery value. And right now, what's interesting is, again, I'll point to New York. People thought office is dead, New York is dead, and what's happened? Because of the need for housing, all of these older office buildings are now seeing the new life as apartments. So you have a dynamic in New York City where the premium office is accelerating. The well-capitalized B office is killing it. The over-levered B office is struggling because no one wants to deal with them. And the just generic office that has floor that is situated where it has enough window line to be appropriate for residential is getting converted. So it's this interesting dynamic that is occurring. And I think, Michael, to your point, when people think about real estate and it's a dirty word, people think about either I'll say the generic father-in-law who always did those crazy deals and always seemed to lose, the only guy in town to lose money on XYZ, or, someone who, the Harry Macklows of the world who put $50 million down and bought $7 billion worth of real estate from Blackstone. Probably not a good idea. But most real estate, especially if it's well capitalized, endures. And from an inflation hedge perspective, because of how construction costs have just skyrocketed, that discount to replacement is a pretty powerful thing. And right now, a lot of property types are trading below replacement cost. And that is huge for why it restricts new supply. But also, when you have this inflationary push on market rents and a steadily growing economy, it makes for good underwriting.
Do you think the lack of calling of risk and the foreclosures you were talking about, do you think that has any long-term ramifications on the space? Banks more hesitant next round?
Well, I mean, there's the constant, let's be real, the original sin was the government bailing out the financial system in the GFC. There were no lessons learned. I mean, Michael mentioned the dot-com. When the dot-com blew up, no one blamed people, just day traders who were like, I want to own pets.com or whatever the favorite sock puppet of the day was. And with the housing bust, the government never told individuals hey, you made dumb decisions on your homes. You should learn a lesson, right? It didn't tell the banks, hey, sorry, you're getting squashed. Your equity, the preferred equity, everyone's going under or getting wiped away, right? So you fast forward, if you look at Silicon Valley, I think the majority of depositors had over the $250,000 deposit limit. Why should there be bailout? So unfortunately, what's happened is there is now a view that everyone gets a bailout. Everyone gets the Jamie deal, if you will, if you want to go rehash from 2007, 2008. And that is moral hazard. And unfortunately, both parties are guilty, but that is a huge dynamic. And I think one of the reasons why people are so nervous about crypto and where it goes is, does that create a risk that the government will bail out banks and financial institutions that get headlong into crypto? And I think that's a genuine thing. When you look at real estate, what I think has changed in a positive is that banks now realize that foreclosing isn't necessarily what they have to do. And operators who have buildings that still have potential understand that if they go to their lender and say, hey, we ain't paying you back this loan, but here's what we can do, that there's a chance that they can keep the property and both parties can emerge well. It doesn't eliminate the bad actors. It doesn't eliminate that if a property is like hemorrhaging cash flow, no one wants to be there and there's too much maintenance that needs to be done. It's just not happening. Yeah, that thing is keys are going back to the lender. But yeah, the moral hazard is real. But I think fortunately for real estate, it's been used in a way that's been productive and helpful to a recovery.
That's really interesting. Those are great insights on kind of the commercial and multifamily resident space. Now, you earlier when we were talking said put aside data centers. So in the REIT space, some of the things you do hear about a lot is the data centers and warehousing. What are your kind of thoughts on those groups?
So we don't cover data centers per se. One of the brokerage companies we cover, Newmark, is pretty active. You know, they have a good brokerage business in data centers. We cover a Texas energy company. I co-cover it with Mark Lear of the energy group, Landbridge, which one of their strategic aims is to bring data center development onto their land in West Texas. The issue with data centers is the obsolescence. And you have the four walls and the roof, okay, pretty standard material, concrete, steel, maybe some unique wood finish for the office up front. But once you get past there, you need significant amount of utility, the power. You need a huge amount of water. You need a huge amount of backup redundancy power. So on-site generators. You also need the cabling. And then you also have a question of who owns the guts, right? So technology is incredible, right? From the big phone that Michael Douglas had in Wall Street, hey kid, this is your wake-up call, to, one of these things that's really small, that obsolescence is real. So when you are a data center landlord, hopefully you don't own what's inside because that stuff will deteriorate quickly as technology advances.
Sure.
The other is that you have space. So if you had a data center that originally serviced 4 customers, but because of technological advances, everyone needs 20% less space. Well, now you have to go find another customer. The problem is that part of your customers, for them, spending $1 billion is the same as whether they want to order sushi for lunch or order some barbecue wings for lunch. It's like a non-issue because these tech companies are so cash rich. The other is a collision with the whole ESG wokeness because power generators don't work on windmills. They need carbon. They need nuclear. Well, nuclear has been a bad word in this country since 3 Mile Island, right? And even here in New York, we just closed Indian Point, which was 25% of downstate power. So now you're seeing people start to reassess and go, maybe nuclear isn't so bad, right? But you also need coal. You need natural gas. You need pipelines. A lot of communities, especially in the blue coastal areas, do not like anything that involves building pipelines. They also have heavy union regulations, which means building conduits and trenching becomes very expensive. There's also the permitting. There's also just legitimately how long it takes this country, I don't care what state you're in, to get a new power plant entitled. So there's the natural wall. And for everyone who says they want to be carbon free, all of our iPhones and every other technology is made up of petroleum-based plastics and other toxic materials that are mined in some far off land, probably by employees who are not up to what we would consider safety code. So there's this conflict there. But getting back to data centers, what it means is there's a huge demand for an asset. And then it's how, as a landlord, do you own that asset in a way that protects you from the real depreciating downside, and also that you don't get outmaneuvered by your tenants who say, you know what, you're a nice landlord, but I don't need you anymore because I'm going to go build my own. So those are the challenges, which makes it more complicated than other forms of real estate because of all those dynamics that I just outlined.
Are some of those dynamics in play for warehousing? That's another group you hear a lot of.
So warehousing is interesting because it really splits out into 2 sectors. There's the big bulk, the classic Exit 8A, right? For you New Jersey Turnpike lovers. Exit 8A, where you see all those big bombers, they're called. Those are really, the interesting part about industrial is valuations are made by size. So institutions want into industrial. The best industrial are the small infill things, but they only cost maybe $10, $15 million. You're a big pension fund. You have $100, $200 million you want to put at work. You're not going to waste your time on these little itsy bitsy deals, right? You want a big deal. The problem is those big deals have a limited number of tenants who will occupy that, sort of the Fortune 500 companies. And for them, I always like to, have fun with P&J, Cincinnati based, but forgive me. You're a bean counter in Cincinnati and you're like, okay, we have 15 DCs nationally. We want to cut it down to 13, cut off 2, right? You're indifferent. So the backfill of those over 500,000 square foot warehouses is tougher. The economics are tougher because there's a limited number of people who will use that. And because they're so big, you can't really subdivide them as easily. Now you go to the smaller size, under 250,000 square foot, the world's your oyster. Why? They subdivide a lot easier. The number of users for those facilities is infinitesimal. And especially the closer you get into communities, the more that you can't replicate it. So most communities do not want new warehouses built close to residential areas. Maybe Texas is the exception. But if you look here in New York, in the boroughs, there's a huge push to ban future warehouses and certainly cut down on truck trafficking. We'll see what happens. But what it means is the existing warehouses become a lot more valuable, right? Because people in New York still want their product instantly, right? So even if the politicians want to crack down on building new warehouses or converting warehouses, or have whatever they decide they want to do, it doesn't change the demand factor. So you have a lot more pricing power. And that's why in warehouse, that last mile, that under 250,000 square foot size is so much more valuable because of that optionality of who your replacement. And remember, real estate has value because someone else wants it. The best building in the middle of nowhere that no one wants to live, doesn't matter how great it is, doesn't matter. By contrast, a rat shack that's on the beach in East Hampton, going to sell for millions, right? I mean, you see that in Malibu all the time. The fires showcase that, where people were like, yeah, my little 800,000 square foot house in Malibu burned down, but it was valued at like $3 million. And you're sitting there going, or $4 million. You're like, how the heck was that? But it's where it was, location.
Sure. I feel like I've heard that before. Location in real estate.
Yes.
It seems to be a theme. You're talking about prime real estate in the office space, the data centers, the warehousing.
But by the way, that's same globally, economically. Like think about the U.S. Like people want to say the U.S. is going to go away or something. Where else in the world where else has the economic heft? We can go around the horn that, but ultimately, sort of the best house in the worst neighborhood type thing. So location matters. And that's what's really, I think, people forget. The other thing is the transformation of real estate overall. Pre-COVID, REIT investors really just wanted to own the coast. Like Sunbelt was like, you can build whatever you want. People learned over the past 10 years that, wow, the Sunbelt actually has a lot more economic growth, and all those cornfields in the middle of downtown got built up. So the cap rates that people are willing to pay in the Sunbelt are really no different than the coast, and sometimes even tighter because there's better growth. And that's really an amazing transformation that's occurring.
Let's talk about the near term. So the Fed cut rates 25 basis points. That is the fourth cut. They cut 50, 25, 25, and now 25. What are you hearing from clients? What are the questions? There's been a lot of macro volatility this year between tariffs, employment softening, the Fed cutting, bills getting passed, and we still got more than a quarter left. And I probably missed a few. So what are clients talking about today? What are they focused on? What are they worried about? What are they hopeful for?
I think what they're worried about is, as great as this backdrop is for real estate, that 4% growth is like all the group has. Mm-hmm. We've had now probably 5 years of really low rates. And so a lot of these companies have debt that reflects that. It's about a 200 basis point headwind on average for earnings. So if REITs used to deliver, call it 6 to 7%, they're now delivering 4 to 5%. If you look at the broader S&P, that may not be as exciting versus other sectors. Now, positive is, unlike, let's say, consumer sectors where sales are up massively, they're down massively. Christmas fell in July, not in December, and therefore the sales were like up, down, whatever. I mean, retail has an excuse for everything, which is incredible. But it also tells you how tenuous that sector is. But for real estate, the issue comes down to investors being, I think what happened is the proliferation of people into real estate. And I think some of the companies got ahead of themselves, especially with like same store NOI. And people thought that real estate moves a lot quicker than it does. And ultimately, in office land, maybe 10% of your leases are rolling annually. In retail, similar amount. Industrial, it's probably 15%. Obviously, in apartments, it's roughly half your portfolio turns every year. But the point is that real estate's a slow moving industry and the stock market is a quarterly business. And, that creates a mismatch. So I think that you have private money that has a public arm. The private side is happy to pay cap rates inside of where the stocks are trading to own real estate directly because they can control the cash flows. On the public side, they're competing for dollars from people who would otherwise allocate to tech, to crypto, to healthcare, to other sectors. So I think what has been hurting the buy side this year is that there are a lot of positives. Even earlier this year, everyone assumed at some point the Fed was going to cut, and yet the group has underperformed. That pressures the buy side. It pressures the fees. There have been, certainly August, there was some degrossing that went around in the pods. So various hedge funds got drawn down. And the biggest risk that if you speak to a lot of the PMs in the hedge fund land is that one of their brethren gets blown out or leaves, and then suddenly their book is liquidated. And because a lot of people tend to have overlapping positions, it creates mayhem. And unlike the long only world where, maybe they can invest for a 2-week period, not a 1-week period, the hedge fund land, you're investing for a day. And so to try to make up any shortcoming is just added pressure. And look, these guys have a really tough job and they're fighting for basis points. And I think that part's been difficult. So it's been a frustrating year, I think, for a lot of the buy side, especially on the long short, because it's just been, you've been grinding and the group hasn't benefited from the prospect of rate cuts the way most of us, including myself, thought it should have.
Yeah, no, I'm just looking at the markets the broader markets have had this big rebound. And I'm looking at a chart book that Stephen publishes every week to our clients. It is our REIT chart book. And we dig through and look at factors, how they're doing within the space. And not surprising, one of the best performing factors in the REIT space is stocks that are highly shorted. So kind of exactly what you're talking about. I can imagine if you're a hedge fund and you're short a bunch of stocks and somebody else gets blown out that is also short and needs to cover, that's a very painful day for anyone who's short those names. And I'm sure we saw a lot of short covering. We have seen a lot of short covering since the lows in April.
Well, even the degrossing, which we're all suddenly becoming experts on.
Sure.
Yeah, I'm learning from, my clients that like no one will know anything. And then suddenly 4:00 rolls around and 4:05, their book suddenly gets whacked. Like, because the firm decided to de-risk or whatever it is. So it's definitely been a tough year.
We've also seen some pretty stark outperformance. Again, this is across the whole sector. So it's obviously different industries within the REIT space have different profiles, but certainly have seen value do pretty well since the lows in April. Risk factors, and we've seen some of this certainly across the broader markets like high beta, high volatility. So again, you've had this huge macro relief going back to April, which has affected everything and why, at least a big part of why markets have initially rebounded. But even though your space, like you said, hasn't performed in aggregate as well, I'm curious to hear it from you looking at the individual companies. It does seem like there's been a rotation within two stocks that at the margin will benefit within. So perhaps that rotation is creating churn for the aggregate, but you are seeing a different profile of leadership.
So I think the one sector that jumps out as a disappointment this year is apartments. A lot of folks, including ourselves, expected, we all knew that renewals are really healthy and stronger than normal. And, more people were staying than moving out. What we thought, though, was that new rents would show more strength, and that did not happen. So while the housing market remains, housing affordability remains a big issue, we didn't see the commensurate steady improvement in new rents. And in fact, there's been a softness. And fortuitously, July's labor report came out first week of August, and we downgraded 2 apartment names, but we were happy that BLS data came out because it showed why new rents weren't performing the way we all thought, because new jobs were not there. By the same token, layoffs are minimal for the most part. So that explains why renewals are so strong, but new rents were soft. And that was a sector where people had a lot of hopes. There was a lot of, including ourselves, of like, hey, there's this housing shortage. We're several million housing units short versus the GFC, all this demand, and it's going to be doing great things. And then boom, it's like, great. Now we have to wait till next year's leasing season. Office has been on the opposite side for people who were hesitant to get back into office because they're like, it's still going to take a while, You know, New York and the East Coast have continued to move ahead. And now you have this rebound in San Francisco, the AI boom, that beginning of the year when we were out in San Francisco, AI was just, it's a nice talking point, but it's not really a big enough user of office space to have an impact, to now, hey, it's a growing factor. And having a new political environment in San Francisco, new mayor, law and order, clean streets, no brown piles on the streets, like people want to come back. Huge difference. You've seen it in office, you've seen it in apartments. And while there's still a 30+% vacancy or availability in San Francisco, the trends are definitely going the right way. And that's been exciting. So office, I would say the fortunes have been getting a lot better. Apartments we just spoke about. Retail's been a slow but steady upward. Malls have definitely gained in favor. I mean, again, a decade ago, no one wanted to touch the mall except for Santa Claus. Now you're seeing people come out to buy B malls. Why? Because they realize that no one's making more of these. And the ones that are there and are still in good shape have a huge market positioning benefit. And, the stocks, I mean, Simon, we have an overweight, but even Macerich, which we're neutral on, both stocks have seen much bigger interest from investors. So I guess, Michael, you've asked me a good question, which now that I think about it, yes, there has been a number of sectors that have seen differences in change. Industrial hasn't changed. That's pretty much the same it's been. But office, I would say, took a few notches down. Apartments took a few notches down. Office took a few notches up. Malls took some notches up. So there's been a shift, but we go back to what we were just talking about before, which is from an investor standpoint, they're still fighting the broader market and other industries for capital. And those incremental retail dollars or institutional dollars are attracted to areas in the economy that are growing quicker.
Yeah. We were talking earlier before we started our recording here about you were asking me how I find time to do certain things. And as you were talking about the malls and the narrative, which has been going on forever, no one's going to ever shop in malls and Amazon's going to take over the world. Well, Amazon's taken over the world, and my 3 daughters would go to the mall if they could all day, every day. And so I do spend a good amount of time there. I live near Garden State Plaza, and it is booming like it's 1999 in there. It is full. People are shopping.
But I think, Michael, you raise a good point. I'm sure you see this from a macro perspective. When general consensus has an outsized view of what's going to happen, generally doesn't happen. The mall was supposed to be dead. Amazon was going to take over the world. Office was going to be dead. Everyone was going to work from home. New York was going to be dead because everyone moved out to Texas. So I think, certainly the philosophy I always take is confident with always an ear open for where we can be wrong.
Yeah. My kids also like to do that everyone thought was never going to happen again anymore. They love going to the movies.
Case in point. So, and that's why, look, when there was this whole beat up the U.S. narrative earlier in the year, it just didn't make sense. Much like the ESG thing did not make sense. EVs don't make sense. There are a lot of things that don't make sense. It doesn't mean that those things won't exist. It just means that they probably will not be of the size and scale that people are projecting to.
Fake meat doesn't make sense.
Well, that never made sense, not even to a segment. But, the point is, when you look at where we are in real estate, and it's why I get so excited by the sector, there's truly minimal new supply. We have healthy occupancies. We have people that want the right product. So when you boil it down and filter it out, it brings you to a subset that's actually demonstrating it. That's pretty cool. The hurdle, of course, are those legacy refinancings. But there are a lot of good things that we see in REITs. And certainly here at Piper Sandler, I think between what you guys provide in macro, what we provide on the fundamental side, the trading, the sales, there's a lot of opportunity for clients to make money. And we look forward to working with all of them.
You always hear the mantra, the sell side loves saying this, and I've been guilty of it as well. It's going to be a stock picker's market, right? Everyone loves to hear that. But when I look at your space, I think it really has been a stock picker's market, because we look at some of the aggregate indices in your space and they've struggled. But oftentimes, I know everyone loves to chase momentum and the hot thing, and it's often hard to outperform that. How many people have really outperformed the NASDAQ over the last several years? Not very many. Where analysts such as yourself can really add value and shine, and certainly institutional investors can differentiate themselves, is in a area that's actually not as loved and where there tends to be more differentiation.
Yes. And it's interesting. I'll go back to office. Everyone said it was dead. No one was going to go back to work. And as I say now, you see companies, happy to pay 150, 170, 200 a foot to be in the right space in Midtown. Pretty impressive.
Well, Alex, thank you. This was really interesting. I'm glad we got you on our podcast. It's a space that is so diverse and I think really interesting and super nuanced. I think you did a great job explaining, and I learned a lot. So I thank you.
Sounds good. Take care.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.